And I think that the feedback that's coming in, if you look at the first quarter numbers of the S&P 500, they were blowout. So first quarter net income growth for the S&P 500 was as high as...
We'll just come back to that point, Gautam, just a second, to whether the economy is continuing to boom or not. Just allow us, I think 20 seconds, I think we're getting into market opening, and the pre-open suggests about 60 points up to begin with at
60
least.
60 points, 200 points in the Sensex, and, it's looking like a good open. We'll have to pick it up from there. So lots of stocks to track, and we'll look at indices as we always do, and then we get down to individual names. About 0.25% higher on the Nifty, 24,900. The Nifty Bank is up about 1/3%, 55,600. The Sensex is up about 0.4. Small cap index is up 0.8. And I think the mid cap index will come up on your screen as well, which is up about 300 points there, 0.5% or so. So this is a good looking start to a fresh new week, and nothing to complain. 20, almost 25,000 by the way, on the index at this point in time after Friday's bumper turnaround. After a couple of sluggish sessions last week, Friday turned it around. And this morning, it looks like there is continuation. So just 3 names on the Nifty are lower. One of them is Indocin. Internal, of course, we highlighted as well. And everything else is starting up in the green. Surabhi.
Okay, up and about. But I must point out the result casualty of the morning is Balakrishna Industries. Look at that stock. It's starting 10% lower. And we'll talk more about the earnings hits and misses in just a bit, because it's been a slew of mid-cap earnings, but that is a nasty-looking cut on Balakrishna. Anyway, on the large-cap screen, 130 points higher on the Nifty. That's what we've got. And M&M is in leadership position, 1.5% higher. Power Grid, NTPC looking good. NTPC, despite lackluster fourth-quarter numbers, still looking quite okay this morning, 1.5% up. ICICI Bank, Ultratech Cement, Hindalco, Tata Motors, Nestle, ONGCs across the board, Trent, Titan, you get the drift. It's cutting across sectors, and most pockets are looking strong. Banks are definitely helping the Nifty's case, because the Bank Nifty is chugging along at an even better pace, 0.6% higher on the Bank Nifty. SBI, for instance, Axis Bank, all these names are on the upside. In fact, there are only 2 stocks that are negative on the Nifty. One is Eternal, and that's a flows issue, because the index providers, FTSE and MSCI, have lowered their, their weighting on Eternal. That stock is down 3.5%. Other than that, everything is positive on the Nifty. 160 points and 25,000 on the board. Nice.
Well, that's right. Just take a look at a few stocks, though, that are bursting away from the broader markets. GE Vernova. The revenue was a little bit subdued, but margins at around 21.9%. That's the highest among the high voltage transformer peers. And that's why that stock is locked up. I think it's up close to around 10% as we speak, with pending buy orders. So big move is what we're seeing on GE Vernova. So big one out there. Kolte Patil, another one that came out with a good set of numbers. So that stock as well is flying away. Large volumes, Kolte Patil is up close to around 8%. Transrail Lighting, revenues grew by 40%, EBITDA went up by 41%. They reported the highest ever revenue, EBITDA, PBT, PAT in the history. So that's great news. And they've got a good, healthy order book as well, which will serve them in good stead. So explains why that is up 5.5%. Keep in mind, the stock ran up a good deal, ahead of its numbers, but yet it's higher. A few more stocks that deserve a special mention that are moving up in trade. You have Reliance Power. Actually, the first tick was quite good on rather large volumes. So that one should come up for you on the screen. Let's see what it's doing. Reliance Infra, actually, the numbers were quite good. I don't know what that stock is doing, because it already had a big run up, in anticipation of those numbers. So big move is what we saw on that one. Reliance Power is up close to around 4% on large volumes. Reliance Infra actually has come in for some profit taking. And JK Cement, pull up that stock. It's up close to around 5%. I told you the numbers were very, very good. We'll wait for the management commentary as well on the con call later today. But otherwise, the street likes it. Up close to around 5% on that one. So good looking screen. Nifty up 150 points. Nifty Bank moving to that crucial 56,000 odd mark. That's the resistance zone. We'll have to keep an eye on that. Advanced decline ratio firmly in favor of the number of stocks advancing.
Absolutely. And, it's looking strong, very, very strong across the board. Just a few other names before we go back to Gautam. You got R Power. Basically, the ADAG, Reliance Power and Reliance Infra were the number 1, number 2 volume lead gainers on Friday. And R Power is back there, 2.5%. It's got humongous volumes for this point in the day. Already. I think we highlighted Divi's. Transrail also is up 7%, 611 on Transrail, again, on the back of numbers which came through. There is MCure, which again reported numbers, and I think have this management later with us today. MCure is up another 8%. It's moved from about 1,070 to $1,400 in basically 2.5 days. I mean, today being the third day. So tremendous gains. Shilpa Medicare is coming up with about a 6% pop. And it's got volumes behind it as well. You just heard from the Narayana management. Narayana is up 4%. Stocks at about 1,800. Narayana Hrudayalaya. NetWeb has been having a pretty decent last few sessions. 3.5 here. 1,862 on NetWeb. We had Nilesh Shah, by the way, of Envision, who was talking about NetWeb as something he likes on the Editors Roundtable on Friday. Phenolics Pipe, ITD Cementation, Shakti Pumps is coming up with a 6% pop. It's got decent-sized volumes as well at this point in time. So, yeah, I mean, there is a lot happening with regards to specific names that you want to look at. Premier Explosives is down about 7%. So that is coming off the high 3 days back was 621. Stocks at $500 now. So it's given up over 100 rupees very, very quickly. But it had an explosive move on the way higher. And HBL Power, HBL Energy basically is down about 4% as well. They do battery systems, etc. A bunch of businesses, 553 or so on HBL. Honasa is the other one on Friday, which had a rocket move, which is giving back about 4% of that move right now. So that's basically the broader markets in focus. 170 points higher on the Nifty. So it's a good start. Surabhi.
Yeah, I just want to add one more stock, Dreamfolks. Bad numbers for the fourth quarter. It's down about 7%. Dreamfolks down about 7%. The other one is GNFC, which had very good numbers. So GNFC is up about 7%, 6-7%. So lots and lots of individual stocks that are moving around today on the back of news flow or on the back of earnings. Okay, let's go back to the conversation with Gautam. Gautam, sorry, we just ran into market opening there, but if you could just complete the point. So from whatever you're describing, it seems as of now the US economy on ground is definitely booming. So I go back to that question. So US equities and bonds, does the money stay or will it keep looking for other homes? And then we hope one of those homes will be India.
Yeah, I think let me complete the point I was making with respect to the S&P 500's net earnings. So the first quarter net earnings grew as much as 12%. Now on the Max 7, but I would say Max 6 because NVIDIA reports on Wednesday, the 28th. So the Max 6 have reported an average earnings growth of 28%. And the other 493 stocks have actually grown by as much as 9%. So that's exceeded consensus earnings estimates by as high as 16%. So that tells you that the domestic equity market is still going very strong. There are no significant signs as yet of it slowing down. But like I said, any weakness in the dollar will prompt money shifting out of the United States and going offshore. So hopefully we should get a slug of that. And we've seen some of that come through, about $5.5 to $6 billion since the lows in April. So I think there is more momentum for money, valuations notwithstanding.
Okay, all right. Hi, Gautam. Good morning. Good to hear your thoughts as always. Gautam, what's the top theme that you have, as we speak? Because the headline index, it was a little cheapish, but we've had a good 15% run from the recent lows. The pockets of the market still are very interesting, and there are longer runway out there. I think power is something that you liked. Some of those EMS companies in the past we've spoken about as well. What's the one top theme that you could share with us?
I think power remains a multi-decadal theme in India, and it's not just driven by domestic power consumption, i.e., electricity and lighting up homes, lighting up, factories. Also by the fact that at the advent of AI, and, I think I may have said this in the past, but a simple Google search, if it takes 1 unit of power consumption, an AI search takes 10x that. So you are invariably going to see a situation in a country like ours where we have 750 million smartphones. Everyone now knows, has an account with OpenAI or with Perplexity or any of the other AI models. So I think consumption of that will significantly go up, or power will significantly go up. The other element that's going to cause the need for power is data centers. And the Indian government is very clear they wants to localize the content of Indian citizens in India and not have it sitting somewhere in Palo Alto or Arizona. So given these complexities, I think you will see the consumption, all aspects of the power industry, whether it's generation, whether it's transmission or distribution, having a multi-decadal growth story. So power would be my number one pick as a sector.
Okay, so power, a powerful theme, says Gautam. Got that point. Overall, Gautam, we've discussed the US in great detail. Overall, while you single out power, what about earnings here? Quality of earning. You just told us that, in the US, earnings expectations are getting beaten by 16%.
That's right.
Here, we are struggling to avoid downgrades, though this quarter seems to have been a lot better. We don't have too many earnings casualties, but what's the sense from a growth perspective? Just looking for growth. What could perhaps stand out over the next 6 to 12 months?
So, Surbhi, you raise a fair point that the growth in the States is as high as I discussed, average of 12% for the S&P 500. So if you're an allocator sitting in the US, you think twice about putting money into other markets when your own home market is giving you such stellar results. But having said that, I think there is a need for diversification. So the money will flow into EMs, will flow into India, no question. As far as domestic earnings are concerned, I think, yes, we still haven't gotten out of the dull phase that we've seen over the past about 6 to 7 quarters, where earnings are not able to climb into the double digit. So my view is that we need still more government spending, private sector spending, with the exception of the top maybe 7 to 8 industrial groups. We're not seeing that much spending. Even if you look at the bank's results, Axis Bank loan growth was 8%. HDFC Bank tepid, loan growth of 4%. So 2 of the biggest banks in India are not lending to corporate India, which means corporate India is not necessarily borrowing. And that sort of is a spiral of why we're not seeing that CapEx hit the ground and generate more jobs, generate more production. So, of course, you've seen Kotak Bank, which had a great loan growth of 16%. But then again, corporate side is only 21% of the loan book. So I think we still have to hope and wait that the government spending picks up. A lot of the research reports that I've been reading over the past few weeks indicate that should pick up momentum the second half of this year.
Okay, all right. Well, with that hope, we wind up the conversation this morning. Gautam, pleasure having you on. Thank you very much, and very interesting insights coming in there from your US trip. Thank you for joining in. Well, let's stick with the earnings then, and lots of numbers have been flowing in. BEML is the next management on our radar. The numbers came in slightly higher than estimates for the fourth quarter, but the issue is on the order book growth and the revenue growth, because for the year as a whole, FY25, BEML has been slightly shy of its own sort of projections and earlier indicated estimates. We have Mr. Shantanu Roy, CMD at the company, joining in. Mr. Roy, thank you so much for being with us. Really appreciated. So I just want to highlight for viewers, the order book guidance that BEML gave out at the start of the year was about 18,000 crores. You've ended the year at 14,600 odd crores. And the revenue growth guidance you had given was 20-25%. But revenue growth is very flat. I think for the year, you've not had growth at all. So can we talk about this first? What do you see? Maybe it was lumpiness of orders, had the orders spilled over into FY26. But let's start by talking about growth of the order book and what sort of revenue growth will you expect this year?
Thank you very much. So first of all, let me talk about the order book. Yes, we could not meet the guidance of 18,000 crores, but the silver lining is that the order book as on 31st March 2025 was around 28% more than what we opened the year 24-25 with. And the silver lining was that out of the total order inflow, the 67% contribution was by rail and metro, around 26% by mining. Defense was a dampener. Defense, we could do only around 9%. But if you look at the overall order book position of 14,610 crores against, again, the rail metro sector, it contributes around 63% to it, 24% from 28% from defense, and around 9% from mining construction. There were a few headwinds. The orders, the contracts did not fructify in the last financial year, but we are expecting that in the first quarter, some of them would, and by the second quarter, it would to a great extent. As far as the top line is concerned, you see it was more or less flat, I agree, but at the same time, the silver lining is that the PBT and PAT is at an all-time high. So that's a silver lining.
Absolutely. No, sir. No taking away from that. The margin performance has been very good, and we'll come to that in just a bit.
Let us discuss the top line. The top line, basically, we have three business verticals. Last year, the contribution was 43% mining, 38% rail metro, and 19% defense. This year, mining has gone up to 54%. Defense has gone up to 27%. But rail is down by 50%, around 19%. So even though, rail did not perform, but still we managed to have the similar kind of top line. There were certain headwinds in rail, some of the order execution that we were planning, it could not happen because of the proto clearance and other stuff. And also, even though rail is having the highest order book, as I've always maintained in the past as well, there is a gestation period. The gestation period is generally 18 to 24 months before we come out with the first proto. So 25-26, the year when, projects like the Bangalore Metro, even the Vande Bharat, the balanced 9 trains, this will all reach its, Vande Bharat will complete the order. Bangalore Metro will start execution. We are supposed to do 20 trains this financial year. So whatever we could not do last year in rail and metro, it will be made up in the current financial year. And of course, defense, there has been a phenomenal growth. And this year also, we can expect a phenomenal growth in defense.
So, sir, can you just help us put that into some sort of a rough numerical range? Since obviously, these Vande Bharat orders, the metro orders are picking up, you're saying defense is picking up. So for this year, what is the kind of revenue growth we should work with, at least right now? What's the visibility? And what is the kind of order book growth, or maybe an order book number that you can share that you see ahead?
So first, let me talk about the revenue. This is just the beginning of the year. We are in the second month of the new financial year. And what we are looking for is around 20%, again, 20% growth in the revenue. What with the rail projects firing up this year, that should definitely become a possibility. If we talk about the spread or the contribution of different verticals, so in 25-26, we should be having something around 60% by rail and metro and defense and 40% by mining. Order book, as far as the current scenario, what it looks like with some spillover orders in the rail and metro. So the current order book of 14,600 crores as of 31st March, we should be hoping to double it in the current financial year. Again, it will be led by rail and metro. 60% contribution will come from the rail and metro. A lot of metro projects which we have already bid for, it will be decided in the current financial year. Some of the rail projects also, like the track machines and all, which we have already bid for, it will be decided in the current financial year. And 20% each from defense and from mining. That is what, it looks like currently. And
so total order book, we should expect, will swell to about 30,000 crores by the end of the current year, right?
I said doubling it. So doubling it should be around 28,000. And from 28,000, we'll be executing some as well. So we should end up the year at around 22,000.
Okay.
20,000. Got it. All right. Hi, Mr. Roy. Good morning. Good to see you, Ben. Let's talk about the silver lining first, as you were stressing on that. Margins have improved for the year, which is heartening. What is the margin target for this year? If you could give us a rough number. You've been talking about margin improvement, so I wanted to understand where do we end this year with, point number one. Point number two is exports as a percentage of the mix. With that 20% growth, how much will it contribute to your revenues?
So the margin, if you talk about the EBITDA, we have achieved a growth of around 12 basis points. And right now the EBITDA is around 13.2%. So we are looking at a EBITDA improvement of at least 15 basis points in 25-26. Exports contributed around 8% to the top line in 24-25. So we are looking at something around 10% on the exports for 25-26.
Okay, all right. So I just want to clear the point on margins from around 13%, 15 basis points or 150 basis points. Will it be closer to around 14.5%?
Yeah, it should be. It should be.
Around 14.5%. So around 150 basis points from around 13%, it improves to around 14.5%. Yeah. Got that out of the way. And just one quick question on the working capital days, that as well has got stretched a little bit. Yeah. Receivable days have moved up, inventory days as well have moved up. On a steady state basis, will this cool off?
It will. It will. That is one of our main focus areas. Our aim is to improve the return on capital employed and the return on equity as well. So the return on capital employed, for that we need to bring down our inventory, and we also need to bring down the receivables. Unfortunately, the inventory it was increased because we could not convert, for example, the Bangalore Metro and the Vande Bharat. We were having the inventory, but the sales will start from 25-26. So this year, 25-26, should see a drastic improvement in the inventory levels.
You want to give us the number, working capital days, sir, that it'll take care of the payables, receivables, inventory days. So, if you're talking about an improvement, how many days? What does it come down to?
Well, it's very difficult for me to, tell you the guidance for the number of days, but what we are looking at is bringing down the working capital by at least 15% in 25-26.
Mr. Roy, hi, good morning. On defense, could you give us, that's been the topic of a fair bit of intense discussion, whether we're going to see a ramp up in defense business, added thrust on indigenization, and you're very much part of that plan. Could you give us a sense of how that is panning out? What have you seen, especially, what have you heard also from the government after Operation Sindoor?
You see, I mean, this current situation, it has been a revelation. India as a country, we as a country, have again proved our mettle. And as a defense PSU, we have been able to contribute in our own way. There is a lot of emergency procurements which will be supporting the government. And our forte is the land systems, the platforms, and we will be supporting the government by way of the platforms. We can expect more numbers of platforms to be manufactured, and that's the reason we see at least 20%, more than 20% contribution of defense to the order book in 25-26. Apart from platforms, we are also working on the combat engineering options like the mine plow, self-propelled mine barrier, and there are other mining mechanical minefield equipment which we are currently doing. So these are all related to our core business in the land systems. And apart from that, we will also be looking at diversification to the maritime naval. We are already working on some projects, as well as contribute to the aerospace sector. So it augurs well for the company. And as a defense PSU, we have ramped up our defense contribution to the top line to an all-time high of 27%. And I can see it growing to at least 30% in 25-26.
And margins here, sir, just 2 points actually. One is on aerospace, what exactly are you doing? Because largely it is land systems, as you said. And second, for this business, will margins continue? Where do they stand, and do you see a continued improvement on EBITDA margins?
Let me first talk about the margins. So margins, as I've already mentioned, definitely there will be improvement. This year, the margins have been driven by two things. One is we were able to reduce our material cost by 0.8%, and even a 1% reduction in material cost adds to the margin in a big way. Second is our sustenance. The sustenance contribution to the top line has been around 26%, and that has been a huge contributor to the margin. So as we grow our sustenance business, I expect the sustenance business to grow by at least 30% in 25-26. So we can expect even better margins. As far as aerospace is concerned, we are already working on several programs with the ISRO, as well as several programs with companies like HAL, and on development projects, mainly for the aerostructures, for the GHE, GACs. And we expect to ramp up the aerospace numbers in 25-26, especially the order book. First is having the order book, and then, 26-27, the execution will really start for the aerospace.
So just for our understanding, ballpark, I mean, roughly speaking, Are your defense business margins lower than metro and rail? I'm guessing metro and rail would fetch you the highest.
Again, that's a very difficult question. Metro is an intensely competitive market. Rail, I would say, commuter rail, the mainline rail, it has got better margins, but metro also, definitely we have the margins, but I would say it is in single digits. Defense, definitely, again, there is intense competition as well. In fact, more than 87% of our top line is from competitive business. So defense, along with high-end mining and the commuter rail plus the sustenance, it adds up to our margins. It helps us in improving the margins. So more we do of these things, better the margin.
The better the profile. Got it. So the commuter rail segment, high-end mining, and some specific defense and aerospace projects.
Specific defense, aerospace, and sustenance.
Got that, sir. Thank you very much. Great conversation, and we wish you good luck for the rest of FY26. Quick break right now. Come back on the other side, and we'll have the management of JSW Steel joining in to talk about the fourth quarter performance.
Welcome back. As promised, let's get chatting with the management of JSW Steel. The numbers were in line and the performance should improve from here on. We're joined by Mr. Jayant Acharya, the Joint MD and CEO at JSW Steel. Hi, Mr. Acharya. Thanks a lot for joining in here on CNBC-TV18. Well, let's start off with focus on the domestic front. How is demand on ground? And also tell us how much higher are prices today if I compare it with the past quarter?
JSW Steel has delivered a very strong operational performance, as you rightly said, on the back of a very strong India demand. Last year, the demand in India grew by about 11.5%, incrementally 16 million tons of steel. The pricing improved towards the later part of last quarter. And I think the benefit of that we will see in the quarter one of this year. So we see an improved pricing environment, giving us a positive flip side on the price realizations in the quarter one 2026. It will also be driven by higher volumes from our JVML capacities at Vijayanagar, which has ramped up to about 90%, over 90% plus utilization in March. That will further improve in terms of volume, as well as with stabilized operation, it will be more cost effective than all our other operations in our hot rolled coil business.
If you could give us a number, sir, how much higher prices on an average for this quarter versus the last one?
I think we would be expecting in the vicinity of 3,200, 3,250 rupees per ton.
All right, got that. Let's focus on the other aspect. That's on the cost side. How much lower were coking coal cost in quarter 4? And how much lower will they be, say, in the coming quarter, quarter 1 FY26?
So last quarter, as we had guided, our coking coal prices were lower in the blend by about $15. And we expect about $10 to $15 in this quarter one as well, on the back of better sourcing and blend.
Okay, Mr. Acharya, hi sir, morning. Great to have you on. What is the outlook on your overseas operations?
Yeah, so overseas operations have improved over quarter 3 and quarter 4. I think especially on the back of a better pricing environment in the United States, we will see better, I would say, improved operational performance in quarter 1 versus quarter 4. Italian operations, there was a delay with the uptake of some orders from the rail system. And we also faced a congestion in terms of evacuation of the rails from our plant. So due to which the volumes were lower, and that resulted in a lower EBITDA. On an outlook basis, I would say both US operations and Italian operations will deliver positively to the EBITDA in the current year. And the bilateral order from the Italian rail in Italy is in the process of getting signed. So we would see improved offtake in this year from the Italian rail.
Mr. Acharya, but will US and Italian operations turn into the green in this quarter, first quarter of 26?
It should be contributing to the overall EBITDA.
Fair enough. What's the outlook on capex and debt in this financial year, FY26?
Yeah, so we have a plan of spending about 20,000 crores in this financial year in FY26. And as you have seen, our debts have gone out by about 4,350 crores in the last quarter, ending March 25. Going forward, I think rather than a debt number, I would like to say that our ratios, net debt to EBITDAs, which have improved from quarter 3 to quarter 4, will continue to progressively improve during this financial year.
All right, sir. I want to question you on the fundraising plans. Any such plans? You'll have taken a couple of enabling resolutions, but will you raise some money?
Yeah, so certain dues which higher cost debt and some things become due, so we keep on refinancing. So those instruments we'll raise through various instruments of the market and refinance those for a better cost-effective interest rate.
All right. Besides the numbers, sir, the focal point is going to be on Bhushan Power and Steel. What is the course of action you all are taking with regard to that particular asset?
Yeah, so the matter is sub judice, so I may not be able to comment too much, but I think it's important to note that we have implemented the resolution plan in full compliance with the law, and we have been able to successfully revive the asset to its present condition where it is today, with increasing operational output, with increase of capacities. The second thing is that we have analyzed the judgment along with our legal advisors, and we believe we have strong grounds for availing all legal remedies available to us.
So it's really important you say that, because I believe that I think there's a plea coming up in the NCLT today from the single side. So what is the current status? Have you approached the courts? Are you planning to do that?
So I think those are under various stages of discussions with our advisors, and we'll be taking appropriate steps at the right time. I may not be able to give you exactly what the status is in the court as of today.
Okay, we'll just wait by for developments on that front, sir. In case this asset comes up for bidding again, if there's a fresh bid, will you be able to participate? Will you participate?
Yes, per the laws, yes.
Okay. And what's the amount that JSW Steel is due to get in case the asset goes for liquidation?
Yeah, so two things. On the downside, as per the Supreme Court judgment as well, we are protected from the fact that the refund would come back to us, number one. Number two, the capacity expansions in BPSL have been done from the internal accruals which we generated at BPSL as per the resolution plan.
Okay. All right, sir. But what is the rough amount that JSW Steel is looking to get in case of liquidation?
So we will be getting the refund of whatever amounts we have paid. And I think at this point of time, that is all we can say.
Okay. All right, Mr. Acharya, final question before we let you go. As you said, you'll be eligible to bid if the asset comes up for rebidding. But will JSW Steel be rebidding for the asset? Can we assume you will be going in for it?
I think that is something which we will take a decision at the right point of time. As of now, as I said, we are pursuing all legal remedies which are available to us. We believe we have strong grounds and we have a strong case.
Okay, well, Mr. Acharya, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC TV18. So that is JSW Steel in focus, and of course towards the end that case which is going to be very much in focus going forward as well. Now the 2,800 crore rupee IPO of the chemicals and oil storage and logistics solutions provider Aegis Vopak opens for bidding today. We have Mr. Murad Molidina, non-executive director at Aegis Vopak Terminals, joining us here in our studios. So good morning, great to have you with us here.
Yeah, hi, good morning.
Thank you very much. Strong demand as far as the anchor book is concerned. So
yes.
Congratulations. And I think we'll see what the retail demand is like.
Yeah, let's watch.
But it's a specialized business, and we'll get to financials, etc. But for our viewers, if you can just start by, you operate terminals for liquid storage, which is chemicals, etc., or also LNG, right? Just describe the business for us at a very basic level.
Let me explain in very simple terms what is the business. So business is setting up storage tank terminals at ports to receive, store and deliver liquid cargo as well as LPG, not LNG. And in liquid cargo, we can store various kinds. We can store petroleum, petrochemicals, chemicals, veg oil, and there is a lot of flexibility. This is a very niche business, like you said. It requires special skill set. It's not a plug and play business. So you set up at a port. These cargo come in bulk. So it's 5,000 KL. 5,000 KL means 50 lakh liters or 10,000 or 45,000 also, which is 450,000 or 450 lakh tons. And you have to unload it within 48 hours, store it, and then deliver as advised by the customers, whether by road, filling up road tankers, or rail, filling up rail wagons, or even delivering via pipelines, as the customer would want.
The liquid part is mostly hazardous stuff, or is it?
It's all kinds. Like I said, even veg oil. I mean, these liquids could be of a temperature as high as 300 degrees centigrade. Now, 100 degrees water boils. Or it could be the other way around, LPG, minus 40 degree centigrade, like more than an ice cream. So various temperatures.
So these usually come in these ISO tanks, right?
No, they come in bulk. So the whole ship is filled with those liquids. We have a marine loading arm like a crane, hooks into the ship, sucks the product, jetty pipeline brings it to the middle, which we call stomach part, where tanks are there. And then you deliver.
So I just wanted to understand the competition as well, because there are a lot of port operators with storage facilities. I'm guessing Adani's as well to an extent. They're in the same line of business. How unique? Basically, how strong is the moat? And the customers, wouldn't they have other options? What about the the competitive intensity?
Let me just start with the customers. If you look at my DRHP, 93% plus are repetitive customers. We are pioneers. 1978, we started this business. And there is a huge customer relationship. My partner, Vopak, has been doing this business last 400 years. 23 countries, very deep-rooted customer relationship. Here, my name, Aegis, is a Greek word which means to protect. So this business is not about competition. This business is how do you build the efficiencies. So we have an in-house infrastructure construction ability to construct the infrastructure quickly and cheaply.
But JSW and Adani, they're big groups.
So
they do count as your peers and competitors, right?
Yes. So they are a little bit different because they are port. So they will build the infrastructure where they are having their port. I go and put up terminals at various ports. That is the difference which makes us a little different. And also the care. This is not a plug-and-play business. And I would crudely say this is not a business of deep pockets because you need to be doing this all the time. It's not like a sidekick business. You have multiple business and one of the businesses terminal. So we are not doing anything else. No road, no Swiggy, no Zomato, no EV.
Okay, all right.
Focus.
Full attention.
Yeah.
All right. Good to have you, sir, in the studio. We here at CNBC-TV18 request you to come more often. I think you require an IPO to get the management of Aegis Logistics to the studio. That aside, let's focus on this issue. It's not very, very cheap. I know that the anchor book is strong. But if I do a valuation parameter, not very, very cheap. So we'll have to see, the returns that investors get. But otherwise, the listed stock Aegis Logistics has given very, very good returns over the years. Few basic points now. You're raising some money by the fresh issue. The debt number is going to come down, right? What is the rough interest savings that you will be getting?
Correct. So let me just give you 4 important points of this public issue. One is that bank borrowings are going to become zero. So 2016 crore are going to be repaid.
Okay.
You take an average 8% interest rate, 160 crores.
100%.
9 months number are 85 crore PAT. So you look at the borrowing reduction that is going to happen and how much that is going to change my PAT.
Okay.
Number 2 is that my 2 liquid terminals have just become operational in March, which is a JNP in Newport, as well as Mangalore expansion. And then 2 cryogenic terminals at Mangalore and Pipavav are getting commission in H1 of the current year.
Yes.
So they are like factories. I have 22 working sites. I have developed 225 acres of port land in 6 ports. And these are going to triple my LPG capacity, the 2 cryogenic which is going to come. Plus the fact you just have to understand that these terminals work on turnarounds.
Right.
So if I have multimodal evacuation started, my utilization would step up.
Right.
So we are just getting hooked into Jamnagar-Loni pipeline, Kandla-Gorakhpur pipeline with our existing terminals also. So all of this is happening in the current FY26 and you will see a marked...
So very, very basic question. Gas terminal and liquid terminals. Which fetches you better margins, better ROCE? Just bare basic, brass tacks
Let me
question.
give you a very easy example for that. Both are crazy. And I'll give you LPG first. LPG, my capex cost under DRHP, CRISIL, independent agency, has reported is one of the lowest, 1/3 than the peers. And it is around 1,200 rupees per metric ton of my capacity. My revenue yield also in DRHP is 1,250 rupees. Okay, 88% is the EBITDA. So I can go up to 80% of my capex cost as EBITDA. So even if I start with a low utilization, it's big EBITDA. And then you grow as the volume grows. In liquid, it's all about change of product mix. It is like this. If you go, and I'll just take a second. If you go and check into a hotel, your checkout time is 12 noon, but your flight is 6 a.m. Will you wait till 12 noon? No. Same here, the product. The rates are monthly. If I find products which evacuate faster, I can get another set of products. Another example, in the same hotel, Virat Kohli checks in, I check in. The rates are different because he needs a little more attention. Similarly, in my terminal, if an acid comes and a petrol comes, different attention, different price.
You're explaining it very well to potential shareholders, I must say.
So you get huge product mix potential.
Right. Mr. Bolina, what are the variables which affect your business? I mean, is it just demand? Is it... And all of this stuff which is coming in, it is for use here within the country, or this is transshipment? I mean, it's going ahead.
So we are, I always tell people, and I say it very crudely, the most fatu person on ground is Aegis, because we are very conservative and risk averse, right? So how we make our infrastructure makes us different. So I said we construct our infrastructure quickly. I take 12 months for liquid, 18 to 24 months for gas. Look at anyone else, they will take far longer. Second, I construct it cheaper than others. So I get back my money faster. Life of the asset is 40 years. Third, what I do is I make it flexible. So I can change product. Fifth, I make this terminal trade neutral also. So I can handle import, export as well as coastal movement. So let's say tomorrow government of India says no more imports. Then what happens to my infrastructure? I can do exports, I can do coastal movement also. Jamnagar refineries will cart their petroleum products all the way to Kochi to distribute. They will not fill up 20-tonner trucks, so many of them, and then it takes so long to... With GST creating a common marketplace, it's been a blessing. So this business is, you have to make it very flexible. You have to ensure that sustainable growth is there for the 40-year life that your asset has. And that is, just lastly I should put in, is that we do not rush into a port. There are 219 ports in India, 19 major, 200 minor. I'm only in 6. I go after demand. When there is a sustainable long-term demand, do I go and put up my infrastructure?
Let's focus then back on numbers. You told us about the debt repayment, the Mangalore cryogenic terminal. 670 crores will be going towards that. So what are the matrices you're working with out there? Volumes, EBITDA contribution, what could that be?
Those are a little bit forward statement, but I can give you this way. That the terminal is capable to do 6 million tons of throughput.
Okay.
My rate of revenue is 1,250 rupees. I have spent only 900 odd crores for that terminal.
Okay.
Now, as the utilization will ramp up in 5-7 years, I would be reaching that peak.
Okay.
So you take your take that what a potential that terminal has.
Okay.
Because I will not be able to step into that forward.
All right. So when you list, then we'll push you more for those numbers. But final question, you have said Vopak quite a few times, and that's a big name globally.
Yeah.
This is a fresh issue. But at some point of time, Vopak may want to take some money off the table, or will they be locked in for a few years?
Superb. So we have done a 3 years lock-in sort of inter-se agreement, part of DRHP. So we have taken into account everything.
So Aegis as well as Vopak, both will not sell?
Yes, both.
Both will not sell for 3 years. They're locked in for 3 years.
It's a joint venture.
So then you'll have to find a way you'll have to do another fresh issue to bring down the shareholding from...
Primary. What it does is primary issue resets your debt to 0 and makes your eligibility more because equity is pumped in.
Okay.
So it's a double whammy in the sense that you get more eligibility so you can do more capex and then you have again made it.
All right. We have got all those points on board, sir. The only point I would like to say is that valuation is not very, very cheap, but you seem to be having a good pitch, as you've told us. And in fact, we look forward to chatting up with you on
Thank you so much.
Thanks a lot for coming down. Well, time to get in our technical expert. I think we have Sudeep, who's joining in from SBI Securities. Sudeep, it's been a good start, a good Monday morning for the bulls. What's your take?
Good morning, Nigel. A fantastic Monday followed by a superb Friday. So while we were a bit jittery on Thursday evening while the markets were approaching 24,600, 24,550 zone thereabouts, but taking support from that 20-day exponential moving average, we have seen a stellar pullback from those levels. And what's more encouraging is that the rally has been now backed with, say, select IT names, banking, as well as mid caps and the small caps. So it's kind of a broad-based rally, and that is giving us more confidence that we could see this rally expanding probably towards 25,300, 25,500 on the upside. On the downside now, supports are rising closer to 24,850, 24,900. Looking at the today's morning derivative data, 24,900 as well as 25,000 puts are seeing aggressive writing, as well as we are seeing some serious call unwinding right from 24,750 to 24,950 series. So what we feel is that now the supports are rising and 24,850, 900 could act as a strong support from here on.
Okay, what about individual stocks, Sudeep?
From an individual stock perspective, a couple of stocks are there on my radar. One is from the large cap space and one is from the mid cap space. From the large cap, it is Axis Bank. Since we are seeing Bank Nifty breaking out above 55,500 and seems it's heading towards 56,300. So Axis Bank here post a 3-4 week consolidation between 1160 and 1210 has finally broken out with volumes, and we feel from the current levels this stock is headed up to 1300 1320 levels on the upside, and on the downside 1180 would act as a strong support. The other stock that is there on our radar is Hudco. Now a lot of these names, Hudco, NBCC, are on that breakout list, and today finally we have seen Hudco breaking out with volumes. The stock has sustained above its 200-day moving average since last 5-7 sessions, although it was a bit wobbly and choppy. But today's price action suggests that from here on, the stock is headed up to 250 to 55 levels on the upside and could be bought with a stop loss at 228 on the downside.
All right, we leave it there for now. Thank you very much for joining us. Good getting that perspective on board. And technicals and price action, really. Now, just a reminder, we are excited to unveil our brand new global business news channel. CNBC-TV18 presents an all-new CNBC-TV18 Prime, a channel that will provide live and in-depth coverage of global markets and economic developments through an India-first lens. In our inaugural episode of The Global Reset, it's a show which will air at 12 noon every day. You will listen into Rajiv Jain, who's chairman and CIO at GQG Partners. Remember, GQG is by far the largest foreign investor in India. That's the inaugural first episode, which airs at 12 noon today. Do tune in to CNBC TV18 Prime.
Welcome back. Let's focus on the paint space. And Indigo Paints, well, they reported a pretty much subdued set of numbers on the growth factor for the fourth quarter. The company has witnessed sluggish growth across its segments. To help us out with how things are panning out, Mr. Hemant Jalan, the chairman and MD at Indigo Paints, joins us on the show. Hi, sir. Good morning. Always good to hear your thoughts. Well, the quarter was a little bit subdued, but the stock price is up close to around 2%, telling you the markets are looking ahead. So give us a couple of guidelines. What kind of revenue volume growth are you looking at for FY26? And if you could help us out with what's the guidance on the margins as well from here on?
The reason why I think the stock market could be possibly rallying despite subdued performance is because you will notice that for all the paint companies, Q4 has been significantly better than Q3. Now, I'm not saying that Q4 are a great set of numbers, but at least the improvement in the demand situation is in sight. And as we speak, when we are more than halfway into Q1 of this year, we see a further improvement in the demand situation and the sentiment happening. So I think we are only a few months away from hitting back to the normal demand scenario when the industry would grow by 7-8% and we would grow by more than 20%. So I'm hopeful that that situation would come about from at least Q2 of this year. But I think you'll see improved numbers on the top line from all the paint companies in Q1 is what my expectation would be.
So, and for you, sir, what kind of a revenue growth can we penciling in for the year, given that demand's going to come back? And also, tell us on the profitability. And when we're talking about your margins, ad spends as a percentage of the mix, that obviously comes up because it's around 6%. Where does that number stabilize at? Revenue, margins, ad spends as a percent. 3 points. Please go ahead.
I would be wary of giving a guideline number as far as top line or bottom line growth numbers are concerned, because we are in the midst or just getting out of the longest spell of weak consumer sentiment that anyone has seen in the last 25 years. So although the signs are good, we can see some improvement, exactly how long it will take for this improvement in the demand scenario to come about is a little difficult to forecast. And therefore, I think we'll have to wait and watch until the demand does come back to its, shall I say, normal levels that used to exist before the last 15 months. Once that comes, we would be happy to give a number guidance. But as far as profitability is concerned, if you notice the whole of last year, I mean, we have only done less than 2% of top line growth, but the bottom lines have pretty much held up. And in Q4, we have done our all-time highest EBITDA number of 23.4% and our all-time highest PAT margins of 15.1%. So I think there is some softening in the raw material prices, which has been continuously happening over the last 5 or 6 months. It looks like that will continue going forward. And that, aided with a little bump up in the demand, I think should see the margins holding fairly steady, if not going up as we move forward.
So, Mr. Jalan, sir, hi, good morning.
Hi.
Two-part question. When you say demand normalizing, because it's been quite a while, several quarters. So when you say normalizing, would you consider 10% growth in a year as normal or single digit as normal? And how far away do you think we are right now from that normal?
So as far as the industry is concerned, and I'm not talking about Indigo Paints, the norm for the industry has been anywhere from a 7 to 9% top line CAGR, and that has pretty much existed over the last 10, 15 years. So that is what I would call a normal demand scenario, where the industry starts growing at anywhere around, let us say, 8%. Obviously, you have been seeing for 5 quarters in a row, the industry leader has been at negative of 5 to 6%, sometimes a little more than that.
Yeah.
So that is very obvious that.
So do you see the industry, like you're not giving numbers for Indigo per se, but do you see the industry, paint industry, come back to that growth of at least 8 to 9% this year?
Oh, certainly. I'm hopeful that it will come by the end of the second quarter. We can see the gradual recovery happening. It's not a hockey stick recovery. It's a gradual recovery, but it is consistent month after month. So I think it will inch back to its numbers by August, September.
Okay.
I'm hopeful that it will happen earlier, but I can't bet on it.
Okay. Last question, sir, before we let you go. Your market share is at around 3%, but you are adding capacity as well big time, the Jodhpur facility. Could you tell us where do you see your market share headed from around this 3% in the next, say, in the next 3 years or so?
The next 3 years, if we can take it to 5%, we'd be very happy.
That would be the aspiration?
Yeah, that would definitely be the aspiration. And all capacity increases are done with a long-term view in mind.
Okay.
And we expect that we would start utilizing those capacities meaningfully in the next 1 or 2 years.
And this expanded capacity, the 2 upcoming plants will enhance your capacity by 80%. What would that mean in terms of revenue potential?
I don't think in the paint industry you can equate capacity to demand or top line.
Okay.
I think that the two are totally independent of each other. Capacity expansion is done with a long-term view when you feel that 3 years down the road, you may hit a bottleneck. But increase in capacity by itself is never a precursor for increase in top line. It's the other way around.
Got it. Okay, all right, sir. Thanks a lot for joining in and filling us in with all of those details. Looking forward to chatting up with you as the course of the year progresses. For the time being, we slip into a short break. On the other side, we'll be joined by Francisco of Bank of America Securities on Global Commodities Market. Stay with us.
Okay, welcome back. As gold and copper prices came off their all-time highs, which they hit earlier this year, markets continued to react to tariffs and geopolitics. My colleague Manisha Gupta caught up with Francisco Blanch, head of Global Commodity and Derivatives Research at BofA Securities, began by asking about the recent correction in precious metals. Listen.
Look, we've been calling for $3,500 gold for the first half of this year. We got there, and we feel the market's going through a correction right now that could last a few months. Now we're still bullish longer term. We think longer term, maybe into the second half or into 2026, we'll breach $4,000 per ounce. But we're going through a correction because some of the extreme uncertainty that we've witnessed in recent months seems to be fading. Of course, it could come back. As we know, the Russia-Ukraine war, which was potentially heading into a ceasefire, into some form of peace deal, seems to be getting farther away from that. Also, we've heard about potential additional tensions between Iran and Israel. And then there is the negotiations around the U.S. budget in Congress. So I think we've hit a couple. We've gone very close to 2,500 a couple times, but to breach that level and keep moving up, we need some of this geopolitical turmoil, some of this policy uncertainty to creep back up again. And again, we expect it to happen into year end and into 26. But for now, we think it's unlikely we will move up in a straight line from here.
Francisco, I know you do not look at cryptocurrencies or Bitcoin for that matter, but we've seen an all-time high in Bitcoin as well for the week. In relative to other asset classes, and because it's the same money moving everywhere, how do you see this money deployed into cryptocurrencies?
Well, I mean, again, this new Trump administration has been very friendly to crypto, so I think that's likely enticed investors to go into crypto assets. We've also seen, of course, a rotation away, as I mentioned, from U.S. fixed income securities with the U.S. downgrade, U.S. debt downgrade last Friday, and I think also, said frankly, even the equity markets are no longer as attractive as they once were because of the uncertainty around tariffs and the pressure from the White House for companies to effectively eat the margin squeeze and not pass as much of the import cost into consumers. So all of that has created if you like, a bit of a cocktail for investors to look for alternative assets. And I think that's where crypto's been shining, coupled with, like I said, the more lax approach on the regulatory front to crypto.
I want to talk about silver as well now, and a fifth straight year of deficit, but the prices haven't really moved with the fundamentals. The industrial demand also seems to have taken a bit of a backseat, not the same record numbers that we saw in 2024. How do you see the silver demand availability going forward, and what's your price sense?
Well, in silver, we are looking at $40 per ounce. We think silver is one of the better investments because, of course, remember, silver is half precious, half industrial. And the precious aspect of silver has been driving it higher. The industrial side has been taking a back seat. But this will eventually change. Of course, tariffs mean weaker trade conditions. And we had a pretty strong trade window between the fourth quarter and the first quarter of last year and the first quarter of this year, where investors were buying in anticipation of tariffs. Now we have the tariffs, so we're going to go into a slower period, which will last for a quarter or two, and eventually we will see another pickup in industrial activity. And again, if you are to model silver, the main drivers are, of course, the price of gold, because silver is largely a precious metal, but also what's going on with industrial activity. And right now, industrial activity is going to be weaker, so that's one of the reasons silver has lagged on the move up the large upward lifting gold prices. It's really the weaker industrial backdrop we are seeing today. But we like silver. It's linked to solar panels. We still expect enormous investment in solar panels and in the electrification of everything. And we think silver plays a critical role. Remember, silver is the best conductor, the best electricity conductor in the world. So it's going to play a very important role. And we think going forward, once we go back into a more stable industrial activity environment, silver will shine again.
Since you are bullish on silver, Francisco, are you equally bullish in other base metals as well? Copper, for example, or aluminum for that matter, or a zinc, which has absolutely underperformed in 2025 till time?
Right. So those three industrial metals are a little different each. We like copper into next year. We think eventually we'll reach 10,500 and eventually $12,000 per ton. It's more of an 18-month view. The one thing in the short run, as I mentioned, is that we remain concerned about cyclical conditions, right? I kind of hinted at that in my comments on silver, but the cyclical demand drivers are weak, and they're weak because tariffs are sand on the wheels of the global economy. It's hard to believe that after all this tariff turmoil, we are not going to see lower growth. How weaker growth we're going to see is the question. Is it going to be, are we going to lose 0.3, 0.4, 0.5, 0.6 percentage points of global GDP? I don't know, but it'll be somewhere around that level. And this is also likely to impact industrial activity. So in the short run, we are a little cautious on industrial metals. Now, looking out, as I said, we are pretty bullish on copper because we think, again, copper is the second best conductor, and we are electrifying everything. So it's a big demand story. China is also putting a big stimulus program in place to counterbalance the tariffs, and there's true scarcity in ores, right? We've seen the refining charges going negative, meaning that basically miners are just getting the copper ores refined for free, pretty much, right? So it's an interesting market where there's scarcity at the base of the raw material, the copper ore, and therefore that's translated to firm pricing action. So we like copper. Aluminum, a bit of a different story. It's a metal that again is becoming more regionalized. The U.S. has imposed tariffs on aluminum imports, 25% tariffs. It's are big numbers, right? I mean, President Trump wants to bring tariffs, wants to bring aluminum production to America. The problem aluminum has, is that it takes a lot of power to make a ton of aluminum, exactly 14 megawatt hours. And that's one thing America cannot get enough of because of all the investments in artificial intelligence. We've heard from aluminum smelters in America that shut down a few years ago. They're like, well, will you reopen? They're saying, well, actually, we're thinking of selling our entire facility to an AI data center. Because it just takes a lot of power. The U.S. would need basically 7 new nuclear reactors to do that. And then for zinc, zinc is used mostly in galvanized steel. And as you know, the steel market has been lagging a little bit. Galvanized steel is basically to avoid corrosion. What's going on with zinc is a little, we have a softer steel market in China. It's linked to construction. Construction in China has been weakening up quite a bit, and there's a little more supply, so zinc hasn't underperformed the rally.
Very clearly. I'll come to energy markets now, and we've seen crude oil prices quite volatile as well. On one side, it was about drill, baby, drill. That's how we started this year. But if you look at the markets right now, the shale gas numbers, the oil and gas rig numbers are not so strong there. We've seen OPEC continue to increase production. The U.S. production is near record highs as well. It's a particular case of more supplies, even a surplus, and a weaker demand. How would you look at the crude oil prices within this?
I think you framed it really well, Maisha. We have a trade war which is pushing industrial demand down, and it's also pushing cyclical drivers down for oil. And on the other hand, we have a price war. OPEC is adding barrels at a time when the market doesn't need those barrels. And of course, next week, we're going to see another OPEC meeting. There's talk about potentially another outsized increase of 411,000 barrels a day. Remember, OPEC's already committed to adding 960,000 barrels a day in just about 3 months. That's a lot of oil. Now, granted, some of it was already there, and some of it is just marking to market what producers like Kazakhstan and Iraq and others are already pumping above quota. So it's not a true increase of that size. But nonetheless, OPEC keeps adding as prices keep falling. Where is OPEC going with this? In my mind, there's three reasons why OPEC is adding barrels. Reason number one is market share. Reason number two is discipline, applying discipline to other members. And reason number three is trying to push down U.S. inflation. Is if you like, OPEC contributing to bring down some of the inflation we've seen in America on the back of tariffs. And which one is the reason? I don't fully know, but there is, I think market share is clearly a very important reason. Saudi Arabia has the lowest market share, not just against the rest of the world, but also within OPEC that it's had in decades, and it's trying to bring its production back, right? Why is it doing it now? Why is it doing it fast? Maybe there's an element of discipline, and why now is maybe there is an element of trying to contribute to reduce U.S. inflation as, if you like, as a gesture to President Trump, which has been asking the group to increase output. So this means U.S. shale supply is going to flatten out. We expect a high oil plateau in the U.S. We expect production to really kind of stop growing. It's not going to fall at these price levels, but it's not going to grow either after 3 years of very fast growth. And at the end of the day, why is OPEC adding production? Remember, main reason is for the last 3 years, we averaged almost $90 a barrel, and U.S. shale production grew by 3.5 million barrels a day. OPEC is saying, enough, we're not going to keep oil this high. Instead, we're going to bring more volume. And rather than having 6 million barrels a day of exports at $90 a barrel, we're going to have 9 million barrels a day of exports at $60 a barrel.